We're officially live on Facebook for the Tuesday edition of the Not Your Average Investor Show. Today, we're talking pro tips for ROI increasing market research with Gregg Cohen. I am your host, Pablo Gonzalez. With me, as always, the man that I like to call GC because he knows how to generate cash flow, because he's got genius concepts, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Everybody, great to be with you. Pablo, I can't tell if you're excited or angry right now. Which is it?
Yes, I'm excited to be on the show. I'm angry I'm not in studio because it's my last day of COVID quarantine. There was all this cool stuff happening. Madison is showing her face for the first time. I don't get to be in studio. So I got a little bit of FOMO. And with us today is our community manager, Madison. Madison, you know what? I don't know your last name. What's your last name, Madison?
Lipson.
Madison Lipson. That's right. We got Madison Lipson. She is officially the community manager of the NYA community. Full-time role. We got her hanging out with us in studio from here on out. You're going to learn more and more about her as time goes on, and her financial education. And as we like to say on the show, if you want to know about owning rental properties in your portfolio, if you want to know about best in-house practices for rental property managers, property management for rental property investors, and if you want to get an edge on the Jacksonville market, you are in the right place. If you want some personalized attention, go to chatwithjwb.com or reach out to Madison here in the chat when you are hanging out with us live, and we will send you in the right direction. Now it is time for you guys. Madison, you know what time it is, right?
The roll call.
The roll call. Let's go. All right. Good. John Henning, good afternoon, all. Nadeem Shah, good morning, good afternoon, everybody. Dean Curry from good afternoon from Rainy, Ohio. Dean, I'm headed your way next week, by the way. We'll talk about that later. We got Greg Stone. He says, howdy, everybody. We got Janer Neva. He says, good afternoon. Janer, is that a new name? We got a new?
I think so. I think
got a new community member. Welcome to the show, Janer. Happy to have you. I got another name here. Kareen Drobot from Miami. Kareen from my hometown. Welcome to the show. Hope you stick around here. We got Jen Filson, the fairy godmother of the Not Your Average Investor Show community. We got Anthony Dida saying hello, everybody. We got Karen. Karen is checking in for the first family, the Malines, the first family of the Not Your Average Investor Show community. The patriarch Ken, the matriarch Carolyn, and the Duchess Karen are all in the house. We got Noah Randari saying hello, everybody from California. We got Gene Ferreter checking in. We got, who else? We got Lee Bishop, the MVP of the Not Your Average Investor Show community. We got Lydia Filson, the mother of the godmother of the Not Your Average Investor Show community. We got Shelly Johnson checking in from B-Town, Bradenton, Florida. We got Steve Lax. He's back. He's checking in from Israel, man. All right. We got it going on today. We got Medj Garcia is back. Drew Barnhill is here. We got Scott Perloff is back. Welcome back, Scott. Good to see your name in here again. Robert Wiesner, past star of the show. Greetings from Marietta, Georgia, where there are no manatees. He likes to explain. We got Denny Davies saying hola from I think Denny's still in Germany, if I'm not mistaken. Who else is here? We got Serge Bourbos. He says hello, JWB. Serge, welcome.
Client Serge, nice to see you here.
Yeah, good to see you here. Who else we got? Man, this is a epic roll call today. I think the people are interested in what you have to say here, GC. I'm excited for this show. Let's talk a little bit. We talked about it a little bit pre-show, right? Oh, Joanna is also in the house. Joanna is passing the baton now to Madison, right? Joanna, so everybody knows, Joanna has been on my team. She's been helping out with the community manager. This thing has grown so much. We are so dedicated to this community that Madison, in-house teammate, is now taking over. She is, I guess we call it the bridge, right? Of the community to the company. Madison, you want to tell us a little bit about your role here coming up?
Well, when I got here, it wasn't really defined. We're working on it. We're getting there. I now have a weekly to-do list, the whole 9 yards. So I'm a marketing coordinator here at JWB. I do a lot of the behind the scenes stuff. So you'll see me a lot on Facebook, posting articles. I'm behind a lot of the emails you guys get, updating you on what's going on with the show, kind of what JWB is doing throughout the week. Article writing. So some of the articles you're going to be seeing pop up, I'll be behind some of those, along with Greg, obviously, my little leader, mentor, holding my hand. So I do a little bit of everything, honestly. You name it, I've probably had a hand in it at some point.
Well said. Well said. And I love how she shares that we just didn't really have a definition when it came to her role in the beginning. And that's real. I think most people, when they come to JWB, especially if it's a somewhat of a new role, we just look for talent. We look for talent, we get them on board, and we figure out the best place for them to be. And Madison, kudos to you for not being afraid, jumping on board here. It's fun being in the community for all of us here, but it's tough to do that the first time. So Madison, we just asked her this morning, we're like, hey, do you want to come on camera and start to talk a little bit? And she's like, yeah, sure. Let's do it. And I just think that should be celebrated. That attitude is awesome. So thank you for being here.
Of course. I'm excited to be here.
All right, Madison. Well, we're happy to have you on board. Another thing that you guys look for talent, and you look for jocks because they're always confident, right? Like Madison is an athlete herself. You could tell in her swagger. She knows how to handle herself in front of a camera. Love it. All right. So Gregg, before we get into, I know that you've been doing some work, buddy. You've been researching some stuff. You got some tricks of the trade to share with everybody. But before that, I think we got a breaking news. Gregg, GC, what's breaking right now?
Well, this is about to be the best day in the entire year for JWB. It is almost golf tournament day. The JWB charity golf tournament is going to be on Monday, and we have just had an overwhelming outpouring of support from all of you, our clients, our friends in the community, as sponsors, and for those who have helped kind of put this whole thing together. We have raised more money this year than we ever have, and we're going to get to do more good than we ever have as well. And of course, as a part of the JWB charity golf tournament, all of the proceeds go to building a brand new construction home and then gifting that home to a very deserving veteran in our local community who could really use a helping hand with affordable housing. And so the stage is set. It's going to be Monday. Just want to say a special thank you to all of you who have donated. Many of you have donated just as a part of normally investing with JWB. If you haven't heard, you can donate to JWB Cares by going to jwbcares.org. Or whenever you buy a property or whenever you do a private loan, we're going to ask if you'd like to help donate. And you can just donate $100 here or $50 there or $200 there. So many clients have been a part of this mission, and I want to say a special thank you. And also we have a special email that just came across my desk, 2-3 days ago. And once I got this email, I just thought it kind of represented the essence of the partners we work with and how everybody not only steps up to support our mission, but goes well above and beyond. I wanted to recognize our friends over at the Ritchie Insurance Group. Whitney Ritchie is our main insurance teammate. For all of you who own properties with us, you probably know Whitney and her team. They serve your insurance needs. And this was just an email that she sent to us. Wasn't something that was required. She already is a sponsor of the JWB Cares golf tournament, but she sent a special email and she said, hey guys, I've been trying to get the other insurance carriers to donate and sponsor for JWB Cares, and I wanted to share some wins with you. We were able to get an extra $1,000 from American Integrity. So thank you to American Integrity. An extra $500 from RT Specialty. So thank you to RT Specialty. And also another $500 from Unitas. And I just thought this was so cool. Whitney, who is a business owner, who's busy, gives enough of her time and talents and treasure to sponsor the golf tournament, and then goes above and beyond to make this thing super special. So wanted to say a big thank you to Whitney for doing that. To everybody at the Ritchie Insurance team, you guys mean so much to us and to this tournament. And the stage is set for us to have an awesome day on Monday.
Little story about Whitney. With no Whitney Ritchie, there is no Not Your Average Investor Show.
Well said.
That's right. That's right. She is who introduced Gregg and I at the JWB volleyball tournament when we first started talking about content. First got a spot for me on this bus, which is something I am extremely grateful to Whit about. I credit her with my entire business. She's a super connector. That's it. But I take credit for her marriage because I introduced her to her husband. So no big deal. So, it's same. GC, I'm so pumped for the golf tournament, man. I think it's going to be super awesome. I can't wait. It's going to be my third year participating in it, right? Like first year I was just hype man in Whitney's tent. Then I was hype man for the tournament. Now I got to kick it off again. Super pumped about it. It's a really wonderful moment where one gets to see the JWB ecosystem interacting in one place and giving the home to the veteran. But there's something else coming up, isn't there? Right? There's another breaking news for you.
So we have clients that are able to come into the office again, and we do a client tour. We do it monthly. And so now, since we're a little bit outside of, some of the major challenges with COVID, we've been able to offer this on a very limited basis for clients who plan ahead, and we can do all the necessary things. Anyways, we've got clients coming to town this Friday. And so I wanted to recognize those clients and welcome them and tell them how excited we are to meet them. Some of them are returning faces. So we've got Dan and Cynthia coming from Laguna Niguel. Did I say that right?
Laguna Niguel,
California.
Or OC, California.
Orange County, California. Dan and Cynthia have been clients of ours since 2012. I've had the honor of working with them personally for many years, and they own 5 JWB properties with us. And they're going to be joining us on Friday. We have Jay and his family coming, and they live in Trumbull, Connecticut. And they have been investing with us since 2016. They have 8 properties that they'll be joining us. And then Tao and her family are coming from Kensington, California. And she started investing with us in 2019, and she has 3 properties with us. So super excited to see all of you. Hopefully you're here on the show or listening in the podcast. We can't wait to see you and get to know you a little bit better.
Outstanding. Quick question from Anthony Ditta. For next year's golf tourney, can clients participate?
We are constantly looking at ways to include our clients a little bit more. It actually came up in our team meeting today. We said, well, geez, we have clients coming on Friday. Are those clients sticking around for the golf tournament on Monday? And Tara, who was leading our meeting, she goes, well, that's a really good idea. We've never actually really kind of like connected the dots on that. Excuse me. So, in the past, there are obviously sponsorships are available, but really, if we were to give spots away to clients like we would like to, that would just be limiting the amount of dollars we could raise for the mission. So we haven't really reserved spots for clients because we want to raise as much money as possible. So, let's keep that conversation open over the course of the next year and find better ways for us to kind of align that and at least have you guys be a part of the day. Even if, you're not able to sponsor, not able to play golf, we would love to have everybody there that we could. My dad actually called me up. He's like, hey man, I want to come and hang out on Monday. I just want to be there. So we'll be able to make that happen more and more, next year. This year, we just didn't really kind of connect the dots that much.
Got it. Yeah, it's got to be harder in the times of COVID to like plan for all these different things. Now you also have this like vibrant community that wants to show up to events, right? Like it's a good problem to solve for, man. I like it. Medj also has a question in the chat. Can she get a client tour in May? What does Medj have to do to get on the client tour list?
Medj, just reach out to your portfolio manager at JWB and we'll be happy to facilitate that. We would love to see you.
All right. Sounds good. Without further ado, my friends, what are we talking about today? Right? Like you put together this category design, not this category, this scorecard, right? This investing scorecard, and people loved it. I think the thing that they loved the most was some statistics that you put out about the different markets and growth rates and all this other statistics. So we thought, why don't we share the methodology that you use in order to provide your own research, right? Like some people can only just go to Zillow, right? Like that's all they do. There's stuff that you got to understand about that. Other folks like big wig JWB folks can invest in big John Burns reports and pay for this data. But there is a middle ground that I think you've identified. And I would love to hear more about it.
Well, I would love to talk more about it because this is one of the most common questions that I get if I get the opportunity to speak or even in our show here or with new clients that are coming on board. A lot of people will say, you know what, I really love the Jacksonville market. Why is this market better than another market? Or why is another market better than Jacksonville? And, it's a question that's really, really important for people to understand and to get an answer because different markets are better in different situations depending on what your goals are. And if you have a certain goal, but you don't align it with that market, you can cost yourself hundreds of thousands of dollars of returns. Or you may go to a market that might not provide as much stability as another market. But the thing that's really been lacking for most investors out there is a free, easy, simple way to compare apples to apples across all markets. Right? Listen, we're not all real estate professionals. We don't all have access to the multiple listing service. So what I did is I've taken what we do at JWB, which we have we have consultants that we pay and we get all this information. And I've taken the approach of, okay, well, if we didn't do that, how can I make this available for the masses to get really good information that's standardized, that's easy? We're going to share the links with you guys today because the goal here is to create ease of access for you and simplicity so you guys can run your own numbers. And of course, I've put it together for you as well. So I'll give you kind of my analysis on it. But it really should just be empowering you all to be able to do this for yourselves and hopefully make better educated decisions for your portfolios.
All right, brother, let's get into it, man. So I think the first thing is let's do a little recap of the things that you look into for investors, things that matter for you as an investor, and so that everybody understands where you're coming from. And when we put together that scorecard, you identified cash flow, upside, entry point, volatility, liquidity, and experience. Are we going to go into any of this stuff as far as the stats go, or is this just like the frame of what we're talking about?
Yeah, it's just the frame. I think it's important that as we look at this exercise, this is an extension of our overall Not Your Average Investor show on Tuesdays, which is we use these same criteria to analyze, note investing with Scott Carson, right? Or any other type of guest that we bring on. We're gonna kind of run them through the scorecard. We just did foreign property investing with Rachel Jensen, right? So at the last 15 minutes or so, we're going to use this same framework because my goal really is for us to kind of debunk a lot of the lingo and the myths so that we can compare apples to apples across the asset classes. So that's what we're going to do here today.
Got it. And when it comes specifically to markets, what you care about is home prices, price appreciation, population size, rent prices, population growth, and is there a vertically integrated company in the market, right?
There you go.
You want to talk through a couple of these real quick and how they relate to each other?
Yeah, absolutely. To really get a handle on cash flow, appreciation, right? All 5 profit centers, stability, right? We are going to have to liquidity, right? All those things that we just saw on the previous slide, you have to have these 6 data points. And now once we've identified these 6 data points, now we're going to walk into how do you get those and how is it free and accessible and simple for all of you to generate this information, even if you're not a real estate professional and you don't have access to consulting or the multiple listing service.
Got it. Love it. So, I mean, you've kind of explained this to me, right? Like home prices and rent prices, that is essentially what's going to show cash flow. Price appreciation comes from that, where you think population growth is going, right? Like that's kind of how you like relate those pillars. Population size relates to stability, right? Like the more established a city is, the less you think that something's going to affect it that's weird, right? Like it stands on its own 2 feet. Vertical integration, that's all about passiveness, right?
Nailed it, brother. Nailed every single one of those.
All right, cool, man. Just double checking. I know my stuff, man. So, all right. So where do we get the home price data from, GC?
So there are a billion places for you to go online and find out what is the home price, median home sales price in your neck of the woods, right? Some are better at providing the data. Some are worse. Some use some segments of the population size, meaning like the market size. Some exclude other things. So as an investor, if I'm putting myself in your shoes and you don't have access to these consultants, right? What is one standardized way to look at home prices data across the board? And I chose Zillow. And I chose Zillow because it's free, easy, accessible. And whether or not you think Zillow is 100% accurate is not the point here, because I'll share with you, right? When you look up Zillow here and you see that the median home sales price or the home value index according to Zillow in Jacksonville is $274,000. I have access to the multiple listing service and the median home sales price in Jacksonville is about $325,000. So I know it's not 100% accurate, but what this allows me to do is then standardize and benchmark across the other real estate markets we're going to compare to. And that's the real value. Is it easy, free, and can I standardize it across the board? And that's really why I would choose Zillow for you to do that here. So there's the link right there. Some of these links are going to be funky. And so we'll go ahead and include those in the chat if we can. I don't know the easiest way to do that. But hopefully, Madison, would you mind trying to, let's see, do we have maybe Pablo's doing it. There we go. Easy peasy. Yeah, so we'll share this link. You guys can check this out while we're going through the exercise today.
And if you're listening on the podcast, we'll have this linked in the podcast. Joanna, let's make sure that we put those notes in the podcast with these links as well. Continue, GC.
Yeah, so there you go. So easy, free, accessible, and able to standardize. So what I did is I went to the common comparable cash flow markets out there, which you guys are going to see. It's Memphis, it's Kansas City, it's Cleveland, it's Birmingham, it's Dallas. And I went to Zillow on all those and just randomly, or not randomly, I just pulled it for that day. What is the home value index for Zillow? And the cool thing is I kind of like stress tested this a little bit. Of course, if I'm going to present it to you guys, I want it to be, up to the standard here. The prices for those other markets were roughly about what I would have expected, right? In Jacksonville, it's about 274 is what they estimated. It's 325 based on the real MLS data, right? In the other markets, the one that I would have expected to be a lower cost were lower cost. The ones that I would have expected to be higher than Jacksonville were higher. So good enough data. And then the key here is free, accessible, and standardized.
Yeah. So when we talked about how you were setting this up, GC, we kind of talked about this idea that, yes, we all accept that Zillow is not perfect data, but Zillow is kind of like wearing some sunglasses, right? Like if you got, let's call them rose-colored sunglasses or yellow-colored sunglasses, you might not see the exact color, but everything that you're looking at will compare with the same kind of like tint to it, right? So as long as you're looking from Zillow in Jacksonville to Zillow in Dallas to Zillow in Kansas City, you're not seeing the exact home prices, but you do understand the relative price point market to market. And that's really what matters, right? That difference.
Yeah. And I'm looking at the chat from what Denny just said here. And I think he brings up a good point. I'm looking at overall markets now, right? I'm not looking at individual properties. I think Denny just mentioned something about how Zillow is quite inaccurate on an individual property. That is real. I would not use Zillow to make individual buying decisions. But if you're looking at an overall market for the practice of what we're trying to do here today to compare real estate markets, it's good enough, right? Not perfect, but good enough. And there's really no other alternative unless you want to pay for the data or unless you're a real estate professional. And you'd have to be a real estate professional who's licensed in every MLS across all of these markets. It's just not feasible. So not perfect data, but for this exercise, good enough and really quite critical to being able to objectively measure performance in each of these markets, which we're going to get into in just a minute here.
Perfect, man. And by the way, Denny said that it used to be really, really inaccurate. This last time around, it said that it nailed the estimates, the appraisals.
Well, so they are getting better.
It's getting better. Yeah, that's what he's saying. Duchess Karen has a question here in the Q&A. She asks, does JWB have a specific goal to help Jacksonville values increase? If so, what medium home price are they reaching for and by what deadline?
Ooh, wow. I love how she sets goals with, do we have a goal? Give us a time and a deadline and a way to measure. Unfortunately, I'm going to fall short a little bit on accepting of this goal. We do have a goal of raising median incomes. When we talk about the value of a vertically integrated company versus just a turnkey company, a vertically integrated company, the biggest differentiator is that they are an active participant in helping to raise median income in your market. Most turnkey companies do not do that. And so we are actively, we care about raising median incomes because it's great for the city of Jacksonville and it's great for all of you as investors out there. Because if you're not actively raising median incomes in your market, your return on investment has a cap on it. Because no matter what supply and demand says, if homes aren't affordable, your home values will not go up. So we do care. And we are an active participant in doing this. That's why you guys see us investing in downtown Jacksonville. We're doing that even though we're not expecting to make great returns on it in the short run. It's going to be a long time before we make a decent return on it. It's more than just making a return for us. So, but as far as a goal or a target date, I couldn't give you an educated answer on that. There's just too much going on. But what I can do is continue to report on that for you. And so, that's maybe that's something I'll just keep adding to our quarterly updates that we do with clients.
Interesting.
So great idea there.
Yeah, that would be cool, man. All right. So we're getting the home prices from Zillow. The next thing that you mentioned was rent prices, right? This is another reason why you want the median incomes going up so people can afford rising rents and we can continue to cash flow these properties, right? Where are you getting this rent price data from, GC?
Yeah, the best source for rent price data that's free, accessible, and can be standardized is the U.S. Census. And so the latest data that they have released, I believe, is from 2019. So from 2015 to 2019, is the median gross rent. And you can just go to this link here that you see. It's kind of funky, so you'll have to check the show notes if you're listening on the podcast, or check the chat here if you're live with us on Zoom. But you can just put any city in here. And so Jacksonville City here has a median gross rent of $1,065. And you can see the United States overall is $1,062. And you can just run those same rent prices for the other 5 markets, which we're going to compare here, or any market that you want to compare.
All right. Is there anything that, how accurate is this stuff? Is this kind of like Zillow where it's not exactly accurate, but it's going to be same market to market kind of thing?
So it's important that we're standardizing it, right? Is it the most accurate? No. And we also have to realize that we're taking data from 2 different sources here, right? We're taking Zillow data source, and we're taking the US Census rents data source, right? Unfortunately, there's not one collective data source. So you don't know if they're using the exact same numbers, or what area are they counting versus what are they not counting, right? So it is not 100% accurate, just like Zillow wasn't 100% accurate. However, we need a bridge. We need a bridge to make sure that for that $274,000 property, according to Zillow, that the rents are comparable for what that rent would be. And so one thing you'll see in the analysis here is that I've used my own expertise, because I see what a JWB property rents for. That's a $274,000 property. And then I've factored that up to make sure that the rents are standardized across the board. The figure that I used happened to be 50%, right? So I used a 50% figure. I took the US Census rents. I increased that by 50%. And that came out to what a typical cash flow would be for a JWB property. And then to standardize that across the board, I did the same thing for a property in Memphis, same thing for a property in Kansas City, Dallas, so on and so forth, to create this standardized approach, even though that specific number, 1065, is not accurate for a $274,000 property. That land okay, Pablo?
Yeah, that lands okay. So it sounds like, I mean, are we going to get deeper into that when you start breaking in the numbers, or is this the last time to fully explain that piece?
I think we can get into it in a little bit. I mean, the main thing here is you need a bridge. You need a way to keep the standardized approach, but factor it up based on knowledge of the asset class. And that's really what I did.
Got it. So basically, would it suffice to be more seeped in one particular market? And if you know the data for that market, then you compare that to what it says on the census, and then use that multiple for all the other markets.
Exactly.
Got it. Okay. That makes a lot of sense. All right, man. Then the next data point is home price appreciation data. How are you figuring that one out?
Yeah. And I love being able to share this in a simple way for everybody to be able to learn from. I get this question all the time. And I frankly wish everybody knew how to run their own home price appreciation data, because it is often overlooked, and people invest in a different market thinking that they're going to get the best overall return on investment. It just doesn't happen. And they could have known this ahead of time. So what we're looking at here is the Federal Housing Finance Agency's website is on the left here. They offer this FHFA HPI calculator. That is a way of calculating what your market's median expected value is, which is another way of saying expected price. And you can calculate that knowing what they do internally is they calculate what their home prices have appreciated at. And then you can use this data to figure out what your market's home price appreciation rate is, even though they don't exactly share it with you. So you got to be you got to kind of know how to work the system here. Let me explain this a little bit easier here. If you guys go to that link there, which again, we'll put in the show notes, you guys can go and check it out if you're watching live here with us.
Which one of the links do you see? The FHFA one or the Good Calculators one?
The left, yeah, FHFA.
Okay, got it. Just
go there. It'll take you right to this calculator. You just simply put in your MSA, which is your metropolitan statistical area. It's the region the market that you're looking at. Put in Jacksonville. It'll let you go back to 1991, which is great data, right? It's 30 years, a little bit more than 30 years of data. And then you choose your valuation quarter. I would choose the most recent quarter, which happens to be 2021 Q3, based on what they have today. And then you can just choose a purchase price, right? I chose $100,000 because it's easy, right? Doesn't matter what number you choose, but you just choose, call it 100,000. It's going to kick out what your expected value for your market is in that quarter, which happens to be $432,000 for this quarter, quarter ending Q3 of 2021. So what that means is if you invested in a property that was $100,000 in 1991, according to the Federal Housing Finance Agency, that property would most likely be worth about $432,000 in Q3 of 2021. All right, so it's good to know, but that doesn't tell you your home price appreciation rate. You then take that information and you just go to a free online calculator. I use good calculators because it's good and it makes me feel good. So you can use good calculators if you want.
Marketing.
And it's really simple. You guys can go and check that out as well. There's a link right there. What you're doing now is you're figuring out your home price appreciation rate because you have the figures. Now you have to figure out the rate. And so it's easy to fill out, right? You choose $100,000 as your purchase price. You choose the dates in correlation with the dates that you chose on the previous calculator. And then what it does is it kicks out a home value appreciation rate, which is, that's the key. That's how you figure out how much your market has appreciated since 1991. And a data point that most investors never understand, but is critical because the theory and the application, the data behind this shows us that most real estate markets tend to repeat themselves over a full market cycle. So if you're in a market and you have really low appreciation right there or lower appreciation, you should probably expect less growth over the next 20 years. If you're in a market that has above average appreciation like Jacksonville does, you should probably expect above average appreciation over the next 20 years, fully knowing that it won't always be that year over year. But supply and demand work, population growth matters, and generally you'll see roughly the same amount of appreciation given that full market cycle.
There you go. So this data point, everywhere else, first one, prices, Zillow, rents, census, one place, home price appreciation data, got to go to two places, right? You got to go to the FHFA website, right? Calculate what a price from 100,000 is worth today, and then go pop that into good calculators. And that's going to give you that percentage rate, right? So you did that for all these different markets in the scorecard, showing everybody kind of like how you built this, right?
I did. There's one caveat here. So I actually have even longer lasting data than this, right? I have data going all the way back from 1982. And, 10 years really matter, right? So, for me, using that data from 1991 all the way through now, I used that data up until last year. And then we invested additionally in John Burns Real Estate Consulting and had even better reporting. And I was able to get data going all the way back to 1982. So the data that I'm going to share with you here, I think I'd be remiss if I didn't share the best data available. Mm-hmm. So I'm going to share that with you on the scorecard that we're going to put together here. You're going to see the number be slightly off for Jacksonville. And that's because it goes back from 1982. So for you, using 1991 data all the way through, according to the Federal Housing Finance Agency, is a great way to do it. I just happen to have even better data. And so that's what I'm going to use when we're analyzing the different markets here today.
Got it, GC. And we got a question here in the Q&A from our good friend from France, Anonymous Attendé. I think this is a good time to just kind of answer these and move on. But hello there. After a long time, a few questions if you can answer today. So I want to get it in, right?
Love it.
Anonymous asks, does JWB work with clients who hold lots to construct homes?
Great question. So what Anonymous is asking is, if you own a lot, would you be able to hire JWB to build on your lot and build you a property that is going to profit from all 5 profit centers? Unfortunately, the answer is no. That's a kind of a clunky kind of like working relationship there. One way we could work with you is if you have a lot, we would happily buy that lot from you. And so if you would like to sell that lot to us, we would certainly give you a fair offer and be able to buy the lot. But, one of the reasons the reason that we're here is to make this a wonderful experience for you as a client. And part of that means we have a system that works, been doing it for 16 years, and we try to limit any exceptions that we have. And so this would be one of those exceptions that in theory, would it be possible to do? Probably, but we've just had to take the approach that that would be worse for everybody overall rather than us being able to do that. So simple answer would be no, we wouldn't be able to do that.
There you go. The hedgehog pokes his head out again, right? You guys stick to one thing and do it well. Second of 3 questions. How do you expect rising interest rate to price of property?
Great question. Something that we just, I think I shared it with the community last time we were speaking. If not, it was on Fortune Builders call that I was on. But the question came up, we are expecting higher than normal home prices next year, even though we're seeing interest rates go up. People are saying, oh, geez, isn't that going to depress the housing market? The simple answer is, in theory, rising interest rates decrease affordability and would soften the demand for housing. So I will give you that. But that's in a normal environment, and that's not the only factor. The most important factor right now is the extreme lack of supply in housing, and that is what is going to more than overpower any dampening of demand due to interest rates. To put it in perspective, we have less than 1 month of inventory. If you're not sure exactly what months of inventory is, I would encourage you to show up for our calls coming up. We're doing a quarterly update here in probably a week or two. We'll get into that a little bit more, but that is an indicator that we have extreme lack of supply. And because of that, it's going to take way too long for builders to build up enough inventory to overtake that. So we're expecting to see higher home prices next year, even though we do expect to see higher interest rates.
Yeah, lack of supply, and there's just a ton of people moving to Jacksonville every single day, right? Like that is very tangible when you live here, right? So for this market in particular. And then third, why does JWB insist on selected lenders while there are lenders with slightly better rates outside of those selected lenders?
Great question. Rates are certainly something that we challenge all of our lenders to be competitive with. It should be noted that JWB does not make any type of referral fee or kickback or anything from any of the lenders that we would match you with. We simply want the best rates and terms, but we also want the best experience for you. And the reality is that most lenders out there promise the world and can't deliver. That means that they put you through the ringer and collect all of your documents for months and months and months. And then, it's not all their fault. I'm not saying they're bad people, but the way that banks typically work is the left hand doesn't know what the right hand's doing. And so many times banks have rules called overlays that they just didn't know. And you won't know if you've never done a loan with them until the 11th hour, which means that you've probably invested months and months and months of your time, and it's really not a great experience. And so that's why we're unwilling to work with lenders that we haven't worked before. My thought on this, and it'll be impossible to prove this, is that the rates that we're able to get for you really are probably the best rates out there, because the other lenders who are promising lower ones probably couldn't close. And so, so that's, from a client perspective, that's why we are very staunch in the way that we do. We feel like it protects the client experience. And then from a business perspective, 60 to 70% of our loans, our properties that sell are conventionally financed. So if we were just waiting and didn't have established relationships with lenders that we knew could close, we'd be causing a lot of risk to the business. And there's 80 some odd individuals in the office that we have to take care of, and thousands of clients that we have to take care of. So it's a business risk to it as well. And so that's why we would be unwilling to work with a lender that's outside of our network.
Makes a lot of sense. You've hit on all these in different calls in the past. Anonymous, we appreciate you asking the questions. Now we're back to our regularly scheduled program, right? So little recap. Home price data you get from Zillow. Rent price data you get from the U.S. Census. Home price appreciation, it's the combination of FHFA calculation and good calculators. Now the next thing is population size and growth data. GC, where do we go for that?
So you go right back to the U.S. Census here for the population data. And I want to tell you, I did a deep dive on this population data because it's so critical. I was curious to see, even before COVID, how does Jacksonville compare on our growth rate of population to other markets out there, which you guys will see in just a second. But what I did is I got through all the data out there. There's a million different charts on the U.S. Census Bureau website, and I found the one that is going to give you MSA data year over year over year, 2010 all the way to 2019. And this is really cool because now we can look and see, well, what's the growth rate from 2010 to 2019? What's the growth rate from 2017 to 2019? Or however you want to splice up the data. So there's that link right there. I would encourage you to save that if you want to go down this same path and start to do some of this analysis. Again, go to the show notes if you're on the podcast. This is really, really cool data, something I hadn't seen so easy and accessible before, kind of going down this path.
All right, there you go. And thank you for the community in the chat, Karen and Drew, that are telling me when it's blurry, when it's not blurry. I don't see it. So you let me know. I keep fiddling with it. Make sure that you can see it. Do you see what's next on this thing then? All right. So now we've got all that stuff, right? So we just went over prices. We went over rent prices. We went over appreciation, and we went over population and population growth rate. The last thing that's missing there is there a vertically integrated company in the market? Is there a database for that, or is there only one vertically integrated company?
Now I gotta leave some of this for you guys. You guys know I'm biased on this, right? Like, I mean, let's be serious, right? I love JWB, right? You know that I'm gonna say that we are the best company out there because it's what I believe in my heart. Is there another company out there that is truly vertically integrated in the single family rental space? I don't think so. You know, my definition of vertically integrated is beyond just doing property management, beyond just doing construction. You know, do they have an innovation department? Are they investing in the area of downtown so that you can increase median incomes? Do they have a whole strategy behind how are they going to raise median incomes over the next 10 or 20 years? I see a lot of companies out there that do property management in-house. Actually, I don't, but I see some, but they're not vertically integrated in one market. They're out in different markets. So fully biased, but that's my approach. And I would encourage all of you to do your due diligence, do more than just listen to the show or the podcast, right? Go and figure out for yourself if there's another company that kind of meets that standard for you.
All right. So there you go. Keeping it real over here, GC. And Lee asked me to put this slide back up so he could take a screenshot of it. Lee, I hope you have it, because up next, we're going to the actual scorecard, right? We keep talking about the scorecard. So now, GC, you went in, you took these data points, you put them into this thing. Talk me through it now, man.
Yeah. So this was kind of the aha moment for me. I said, okay, now that I have this standardized approach of understanding market by market, how do I compare each of these? I needed to be able to take the expertise that I have and the tools that we have and to kick out what is your monthly cash flow, kick out home price appreciation rates, right? I can clearly see population growth. So how do I basically take all of that data, standardize it across the markets, and now start to analyze it? And so for all of you data junkies like myself, you guys are going to love these slides. Feel free to take pictures. I'll figure out a way to make this available in some way, shape, or form for everybody. But I haven't seen any data like this across different single family cash flow markets. So I would encourage you to use it. Home prices, if we look there, I just took the information that was on Zillow. You can see Jacksonville's is 274,000, which was what was referenced there. Rent prices, I just took what the US Census gave us. As you can see there, it's 1065 for Jacksonville. And you can start to see some of the other markets out there, how they compare with rents and prices. We're going to do a little bit more of a deeper dive on the next slide. So just hold those questions if you're wondering what that means for cash flow in just a second here. Home price appreciation rate. This is really, really, really one of the major separators. All right. So according to John Burns Real Estate Consulting data, since 1982, the average appreciation rate across the country is 4.5% per year. A little bit higher than what I expected, actually. But better data, longer term. So 4.5% is what the real estate market across the country has performed at. Now you start to see what we would define as a growth market. You know, a growth market would be anything that's above 4.5% home price appreciation. And you start to see Jacksonville really excel here. Since 1982, our home price appreciation rate on average is 4.6% per year over 40 years. That's a lot of appreciation. And you typically don't see growth markets in those same markets where you can get positive cash flow. We're going to take a look at that in just a second here, but you can see the rest of the markets here, right? You see some slower growth or no growth markets, right? My favorite market that I like to talk trash on is the Cleveland market. I have good friends in Cleveland. I have good friends and colleagues in Cleveland in the real estate space that I think very highly of. But the reason I like to talk a lot of trash is because of their football team, because I'm a Pittsburgh Steelers fan. And you know, they are also really kind of the opposite real estate market of Jacksonville. They are one with low home price appreciation over those years, 3.2% versus 4.6% in Jacksonville. And we're going to start to see what this means in real dollar figures if you choose to invest in a market that does not have as much appreciation. There's a reason for it. We'll take a look at that in a second, but we're going to take a look at what that means in opportunity cost as far as home price appreciation.
Got it. Is there so
yeah, there's probably something more that I want to talk about there too. I know I gave you the silent cue of that I was done, but I'm not really done.
Okay, sorry, bud. I was ready to jump in for you, bud.
I know, you're so good. You're the best co-host, man. Population growth, another big thing that just blew my mind as I was diving into this. You know, across the country, According to the US Census, the population has grown 1% from 2017 to 2019. Again, this is pre-COVID, right? Look at the differences in the different markets of who is moving there and who is moving out, right? Cleveland. I'm going to kind of beat up on Cleveland again, right? People are leaving Cleveland. It is not growing, right? Look at Jacksonville, 3.6 times the national average as far as population growth from 2017 to 2019. And we are known to be one of the markets that has benefited the most as far as population growth since COVID. I can't wait to see what the numbers look like through 2020, through 2021, through 2022. The disparity should continue to be larger, especially in places like California and in the Northeast. So you see big population increases in Dallas and Jacksonville, which we probably heard about, and you see slow or no growth for population in the other markets there.
Got it. Yeah. I mean, that's what really, jumps out of it, man. Like it's this idea that there's only 2 markets that have a 3% or more appreciation rate. And then outside of that, it's like Kansas City is like 1.4. And then the other ones are below 1 and Cleveland's negative, right? Like that to me seems that's like what you're optimistic about, right? And then you compare that to actual population size. Dallas is like massive, right? We know that Dallas is one of the biggest cities in the US. Everybody else is somewhere in between like 1.5 to 2 million, or at least close in there. Just feels like, those numbers, when you're looking at it on the chart, if you're following along on the podcast, just really stand out at you. And then you've also put in bold, the Jacksonville numbers where they're, it's hard to find one where it doesn't compare favorably. Maybe home price is the only thing that seems like it wouldn't compare favorably, right? It's on the higher end of the price spectrum at 274 and Dallas is 293. And then after that, everybody is like high 100s, low 200s and like 100,000 kind of thing. But when you look at that plus the rent, the rent is just like way higher than everybody else, right? So I guess that's what you're looking at.
Well, we're going to take a deeper dive on that in the next slide here in just a second. But before we go there, as far as just a couple comments on population size, the way I would look at this is anytime you're investing in a market, you want to have at least 1 million people there because that increases stability, right? Is it better to have 5 million than 1 million? Yeah, absolutely. Is it better to be 5 million and growing versus 1 million and not growing? Absolutely. So you can see Dallas really start to separate themselves there. But, I wouldn't say that, a 2 million population like Cleveland is dramatically less stable than 5 million for Dallas, right? Kind of once you get to that million threshold of population in an MSA, you're kind of good. That's a stable market. So I would think all of these kind of fit the bill there. Dallas just happens to be 5 times, the stability of Birmingham according to the population size.
Yeah, I mean, Drew's saying that Dallas is set to overtake Chicago as the 3rd biggest metro area in like 8 to 10 years, right? So, Dallas does have something going as a great American city, right? Like it is world renowned, right? So everything's bigger in Texas, I think they say.
There you go.
All right, so let's dive deeper. GC, we're going one step. We're clicking in. Now we've got this purchase price, monthly cash flow, home value, total cash flow, total appreciation, and cash flow from appreciation chart. Talk us through it.
Lots of numbers here. All you data geeks are probably loving this. And if you're not a data geek, you might be falling asleep. But I think this is the holy grail. This is a apples to apples benchmark standardized comparison using free accessible data that you can objectively compare different markets. This is the rental property market investment scorecard. So what I did here is I took all that data and then I standardized it even more. Okay, what I mean by that is I took the purchase prices, which you can see in the far left column, purchase prices today. Those are all the same ones from Zillow. I took exactly what Zillow said. The next column was monthly cash flow. Well, in order for me to understand what monthly cash flow is, I have to understand other assumptions. I have to understand what the rents are. I have to understand what the expenses are as well. So for the rents, kind of like we talked about before, what I needed to do was to take that information I got from the census and use my information from what I know for the JWB market, and I needed to factor it up. So I factored the rents up 50%, standardize that across the board. So if I was being extra generous to JWB, I was extra generous to Memphis and Kansas City and Cleveland, right? That's important. Then I looked at insurance costs. I did some digging. I got property evaluations from all the providers in these markets. And on average, you saw insurance cost about 0.6% of the purchase price. That was really across the board. So I used 0.6% as that figure there. Taxes, property taxes we're talking about, they're a little bit different in Dallas. Many of you know property taxes in Dallas and in Texas overall are really high compared to other markets. You can just ask anybody, they are. And so I estimated 1.5% of the purchase price for taxes based on the evaluations that I researched in the Dallas market. And everybody else, it's about 1.1% of the purchase price for your property taxes. So standardize as much as I could, just although using my expertise to kind of tell you what things are like in Dallas there. And then property management fees is standard across the board. So if you have rents, right? Excuse me, if you have purchase prices first, you have rents that are standardized across the board, and you standardize insurance costs, property taxes, or property management fees. Now you can kick out what your monthly cash flow is. And that's what I was able to do here. So now what this means is that this is a standardized way of doing it. So is every property in Memphis going to give you $500 a month in cash flow? I don't know. It's a standardized way of doing it, right? It's not the end all be all. Everything is going to fit exactly perfectly into this box. But if we're standardized, then we can gain analysis. We can gain insight from this. And you can see which markets start to separate themselves. Memphis, really high on cash flows. Look at Dallas. Cash flows in Dallas are negative right now for this standardized approach. And that's what I'm hearing from other providers and other clients there. In Jacksonville, you guys can see here, we've got about $69 a month in cash flow. So slightly over break even, which is what all of you see on the property of the weeks, right? We're somewhere around, call it $50, $100 a month. That's what the market's bearing right now as far as your monthly cash flow. So how did I do with that one, Pablo? Or should we jump right into the home values and total value here?
No, that's pretty good, man. Listen, I think it's interesting, right? We talk a lot about on the show of cash flow for you being the just ticket to the dance. You don't put too much value into high cash flow as much as just having cash flow, right? So like we talk about that often. I think when we're coming up next, where spoiler alert, Gregg's going to give a pitch for each different city and why you would invest in it. So I think you're going to get into that, but let's just keep breaking it down. And so that way our friends on the podcast can follow along, even though they can't see this. And really, if you're on the podcast, join us live one of these days. Go to nyais.com, join us in here. It's a lot of fun. Continue, GC.
There you go. So now, once we know what the cash flow is today, my job is to take care of your money for 20 years. For a full market cycle. And I wanted to run the same standardized approach across all these markets, taking into account cash flow over the next 20 years and total appreciation over the next 20 years, and then total it up and then see which market wins. Okay. So home value in 2042, 20 years from now, what I did is I took those historically accurate average home price appreciation rates that we just talked about getting, and then I applied those. So in Memphis, that property would be worth $278,000 in 2042 if it continues to appreciate the same way it has over the last 40 years, right? $137,000 purchase price today, $278,000 in 20 years. Really cool to see that appreciation. Funny that many investors out there don't factor in home price appreciation. I mean, I'm factoring in, what is that, $140,000 of return there? I'm factoring that in. I don't know about you guys. So really cool there. But you start to see some really big disparities, right? Take a look at Cleveland, my friend Cleveland here, right? $99,000 purchase price, worth $186,000 in 2042, which is a lot again. But when you compare that to the growth of Jacksonville, right? A purchase price of $274,000 today, if all things shakes out the exact same way it did over the last 40 years, you would see a home value in 2042 of $661,000 for your home in Jacksonville. So serious appreciation there. You start to see some differences. Now, those last three columns on the right are really kind of the holy grail of why I believe Jacksonville is the best market. Spoiler alert, you guys kind of probably assumed this. I've done all of this, not maybe to this level of detail before, but this is the reason why we chose Jacksonville and why we continue to invest here, is because I think it has the best combination of cash flow and home price appreciation. And the way that I tally that is I add both of those over a 20-year cycle and I see which one's more. And that's what I've done here. So your total cash flow in 2042, this is a simplified way of looking at cash flow, but it works because it's standardized. You're going to see really high cash flow plays in places like Memphis, Cleveland, Birmingham, right? You're going to see lower cash flow plays in places like Kansas City or Jacksonville, and you're going to see negative cash flow in Dallas, right? It's going to cost you money every single month, most likely, to be able to hold on to a property in Dallas based on the way the market is right now. And then total appreciation, you see the difference here. Jacksonville wins by a large margin, $392,000 of total appreciation, again, based on historically accurate numbers that have occurred over the last 40 years. Other markets like Cleveland, I mean, it's a smaller purchase price to start with, but you're only getting $87,000 of appreciation. That really matters. That really matters. So if you take the total cash flow and home price appreciation, you take those cash flow blinders off. You think about all 5 profit centers, of which I'm talking about 2 here for simplicity's sake. You total them up. Memphis total score here is 269,000. A great investment when you started with 137,000. So I'm all about it. But is that the best total score? No, right? Kansas City's at 286. Cleveland is at 201,000. Dallas is at 303,000, which is the first one in the 300s, but you had to go negative cash flow to get there. Birmingham is 263,000, and Jacksonville comes in at $409,000 for a total cash flow and appreciation play. And in a nutshell, this is the most objective and simplified way I can possibly share what's in my heart and my mind as far as why I think Jacksonville is the best market if you're somebody who is looking to buy and hold for a long time and you want enough cash flow for it to be positive, but your main goal is the biggest and the best total return after 20 years. This is what this chart is showing you there.
If your main goal is the biggest return over 20 years, it's Jacksonville, right? Like if you're looking at this thing visually and you trust the data, I mean, it's kind of hard to argue against it when at the end of the day, the total, everybody is somewhere between like 200,000 to 300,000. And then Jacksonville's at 400,000, right? Like it's a full third more. Denny Davis says in the chat, even if Gregg's number ends up overstating appreciation by a whooping 25%, Jacksonville still wins, right? Gregory Stone puts, I'll take Jacks for $409, Alex.
That's awesome.
Like that little Jeopardy joke. Drew Barnhill asks, do those appreciation figures take into account leveraging?
No, they don't. It's just what the market value was and then what the market value is later on. You just simply take what the market value was and go 30 years later. If you're going to the FHFA website, and you got it right there.
So this is for a cash purchase then?
Yeah, I'm just taking financing out of the equation here. Just using your as if your purchase price today was a full cash purchase. Your home value, if it, in Jacksonville's market, if you bought something for $274,000 today and it went up 4.6% per year for the next 20 years, that property would be worth $661,000. Beautiful thing.
There you go. So with leveraging those numbers, appreciation numbers would increase dramatically, right? Like your ROI numbers would increase dramatically, essentially,
exactly. Right? Exactly. Yeah. We haven't gotten into the ROI effects here. We're just looking at the market right now. But yeah, with a little bit of financial engineering on top of this data, you guys can create so much financial wealth for yourselves and for your families.
That's incredible, man. All right. So let's go to the scorecard side of it, right? Like, so how do you rate this thing, right? So this was data. Now we are scoring it, right? So talk us through this like 1 to 5 scale and how you're looking at this thing.
Yeah. So I really tried to be objective again and look at all of these markets and for what qualities they excel in and which ones they don't, Jacksonville included there. And so this is where they all stack up. So this is that same scorecard that we use for every guest that we bring on for different asset classes. Well, I put that together for us. As far as cash flow, I'm looking at monthly cash flow, of course, from the previous slide. And you're going to see your top producers are Memphis, Cleveland, and Birmingham, right? Your lowest producer is Dallas, and Jacksonville's in the middle with Kansas City being a step above Jacksonville there. So your 5s are Memphis, Cleveland, and Birmingham. Jacksonville's a 3, Dallas a 2, and Kansas City is a 4 for cash flow.
Why is Dallas a 2 when it's negative?
That's a really good question. So I thought about how I was going to standardize this, and this is across the entire, across all markets. I thought it was important to do, right? Like if I was just using these 5 markets, I thought it would be slightly limited, and I thought the scorecard would mean less. So my mentality here is across all markets in the country. And the reality is it's hard to get positive cash flow. There's very few markets out there that get positive cash flow. Most markets are a lot more negative than Dallas is. And that's why I put Dallas as a 2.
Got it. Okay. So it's still in the game in the sense that it's negative, but it's not so negative that you're taking it off the table.
Yeah. If you put something like California cities
or Miami or whatever.
Monterey or Miami, yeah, you're way more negative.
Got it. That makes sense. Okay. So is there anything to walk through? I mean, I think this is one of those things where join us in the Facebook group and you see these numbers put down, because at the end of the day, you just rated them 1 through 5. I think the numbers speak for themselves. GC, what I'd love to hear from you is give me the pitch for investing in each one of these real estate markets, right? So you got, if I am Memphis, what would you pitch me on? Or I guess you have them grouped here, right? Like you got Memphis, Cleveland, and Birmingham have a similar pitch, right? So you're a turnkey rental property company in Memphis, Cleveland, and Birmingham. Why would I do business with you, Gregg Cohen?
All right. If you are thinking about investing and you're talking to somebody in Memphis, Cleveland, or Birmingham, I'm going to give them their pitch deck for them. They're talking about low entry point. They are talking about little money out of pocket, and they are talking about max cash flow. And so if you're an investor who wants max cash flow and you have limited funds, and that's all you are concerned about, you're not concerned about appreciation or upside, you're not concerned about holding on for a full market cycle, those markets are probably better for you. They're probably the best markets for you to go to out of the 5 that I happen to choose. So max cash flow, low entry point for the markets in Memphis, Cleveland, and Birmingham.
So if I've got like 25 grand and I'm only going to hold it for 5 years, you think Memphis, Cleveland, or Birmingham is the way to go?
I don't know if 25 grand will do it for you. Maybe. The prices here in Zillow, I think, are lower than what really the prices are in the other markets out there. So I still think you're probably going to need 30, including closing costs, 35 maybe. Okay. But that's less than Jacksonville and less than Dallas, right? You're going to need 50 as a minimum in Jacksonville and more than that in Dallas. So yeah, so if you're somewhere around, call it like that 35 range, and you want to get in the game, and you want to take action now, which I think makes a lot of sense to do that, because your interest rates are going to be lower and because your home price appreciation is going to be higher over the next year than if you wait. But here's the key. If you are investing for a short period of time, right? If you're investing for a long period of time, you're going to make more money by waiting and investing in a market that has both upside, meaning appreciation, and cash flow, which is a different market, also known as Jacksonville.
Yeah, we're going to get to the Jacksonville pitch, GC. Relax.
Sorry.
Right. Give me the KC pitch.
Yeah. So KC,
apart from ribs, why would I invest in?
Well, good ribs there. Yeah. So KC is above average cash flow. So better than what your normal cash flows would be, better than cash flow break even, right? Maybe not the maximum cash flows. And they're going to be a lower entry point. So somewhere in between kind of your Dallases and Jacksonvilles and your Memphises and Cleveland and Birmingham. Nice middle of the road, above average cash flow, and a lower entry point. That's your Kansas City market.
Got it. Okay. So that is above average, lower entry. What makes it better or worse than the Cleveland, Birmingham? Like if it's, slightly less cash flow, slightly higher entry point, does it have something that edges those out, or is it just diversification at that point?
We could go back and look. I think their population growth was about 1.4% in Kansas City. Yeah. And if you look at Memphis, Cleveland, and Birmingham, I think they were in the zeros. Yeah, if I remember correctly. Yeah, there you go. So population growth, Kansas City, 1.4%. I think population growth is one of the most important factors to think about here, because population growth drives home price demand. It drives rent price demand. It drives liquidity, right? If you got a lot of people moving there, it should be easier for you to dispose of your asset than not. So I think Kansas City has an advantage there based on the standardized data that we looked at. And I think those matter.
Got it. So if I'm Big Bill and I'm in Dallas, Texas, what am I selling you right now? Big
Bill in Dallas, Texas, you are talking about what a great American city Dallas is, and how you'd be crazy if you didn't want to own a piece of America down in Dallas, Texas there. Yeah, but you'd be right to talk about your large growing population. I think maybe it was Andrew in the chat was talking about how Dallas is going to overtake one of the major cities here soon. I mean, it's going to happen. I mean, people are moving to Dallas, people are moving to Texas, just like they're moving to Florida. So you're going to talk about large growing population, and that's important for stability, right? There is when you have 5 million people living there and you have X number of Fortune 500 companies in a market, that is better than 1 million people if you were comparing, apples and apples to apples there, right? 1 million is still good enough, right? My theory is if at least 1 million people, you're good. You have a stable market. But is 5 million better? Of course. So you're going to be talking about that, and then you're going to talk about above average appreciation, which Dallas has shown to do that over the last 40 years. Of course, they have benefited along with other, Florida and Texas have benefited the most from population growth since COVID as well. So I'd expect that population increase to be even higher for Dallas than what the national average is if we look at the same data 2 years from now. So you're gonna be talking about both of those things. Cash flow is going to be a little tough. You're going to go get a little cash flow negative on average, but you're going to be there because you know that city is going to be strong and stable, and it's not going to be beholden to a company leaving and putting a big dent in your plans as other cities may be. And you're going to be hanging on for long-term appreciation.
I would also add to Dallas, if I was selling really hard, just positioning against Jacksonville, I would also say that landlocked city, you don't have any exposure whatsoever to sea level rise or hurricanes or anything like that. If they really want to talk about that, right? Does that hold any water?
Sea level rise, sure. Yeah, absolutely. I think that's cool. I mean, we're thinking 20 years out, so a lot still to be determined there. Now, I mean, that's a really good point. As far as natural disasters, right? You name a city in the country, and there's a natural disaster that can hit can hit that city. So I'm sure Dallas has their share of ice storms. Didn't they have an ice storm last year or something? I mean, I don't mean to pick on Dallas for having a natural disaster. I think it's probably a bad thing to do, but there's insurance for all of that. And so you can kind of choose which natural disaster you're least likely to receive. And maybe that's maybe that's why you choose Dallas.
Gotcha. I mean, you also got Jerry Jones's hot tub in there, so that helps a lot. I heard it's the size of Texas. All right, and finally, if you've talked about it, right? So then, what is the pitch for Jacksonville?
Jacksonville is using this holistic view of how your dollars are working for you in rental properties, and if you want the best, highest return on investment, including all 5 profit centers, and you're willing to give up lower cash flows to get it, then you're coming to Jacksonville. And you're going to be excited about the growing population that we have here, which is another great indicator of future upside and future rent price appreciation. And then the experience is why you're going to come here. The JWB team, a vertically integrated company that's thinking beyond just your here and now, beyond just collecting rent for you. How are we going to take care of your money for the next 20 years? That's why you're coming to Jacksonville.
Love it. So, I mean, I hear that, and I'm just thinking, if I'm in it for the long game and I want the most money for my money, I'm going to Jacksonville, right? And on top of that, the team, right?
Yeah, absolutely. The opportunity for returns is what attracts people to Jacksonville from what we find. Everybody says they have the best team. So if we just stand mountaintops and say we have the best team, but you've never really worked with us, then that's not going to matter all that much, the team component. But once you become a client and once you put your money on the line with any provider out there, that's where the team really matters to you. And so that's why you come to Jacksonville.
Love it, man. I love it. We got a question from Serge Burbaz. Serge, let me know if I'm saying that correctly. Burbaz.
I can help. Serge Burbaz.
All right. Greg knows. All right. Serge asks, do you have any analysis comparing single family residences versus multifamily syndication passive investments?
Do I have any analysis? Not off the top of my head. But Serge, if you have a question, like I said, we pay a healthy amount to John Burns over at John Burns Real Estate Consulting, and they're an awesome team to work with. And I've fired random questions to them, and they've given me really great data. So if you have a question specifically about that, just reach out to your portfolio manager, and that'll come to me, and we'll see if we can get that information for you.
Love it, buddy. GC, good work. We went a little bit over, but we had 50 plus people on for an hour and 10 minutes. Now we're still up to 47. I think it's incredible, man. You put a lot of work into this. Great explanation. I think it really shines a light on the data that's out there. You know, we keep on having been here early on, right? Like early 2020, I had so many questions to ask you, right? Like I didn't have a resource to find this type of stuff out. And I think that this interaction with our community and continuing to paint a clearer and clearer picture and answer those questions has really brought the best out in you, man. Because this is the most concise explanation of like what I couldn't tell my buddies of why I was pumped up to be working with JWB 2 years ago, that I've ever heard so far, man. So really great job putting it together, man. I thought it was really, really illuminating.
Thank you, brother. I really appreciate that you saying that. I definitely think that this community brings the best out of me, brings the best out of you, brings the best out of our community here. It's supposed to be a place of learning and transparency. And so I'm really, really stoked that you guys find value in it, and we'll make this available for all of you. I really, even if you don't understand, or maybe if you thought that I was a little off on how I did parts of my methodology, I would love to see the feedback. Right? Because, you know, however you would do the methodology, the way this was built is that it should elicit similar results, because you can change the factor here, or you can change this here. So yeah, let's keep the dialogue going. But I really think in my heart, this is the most objective way to analyze other markets. And so hopefully it provides value for all of you.
Love it, man. Love it. If you're at home and you're kind of gonna practice this stuff, put your numbers into the Facebook group, right? We'd love to see you come up with other spreadsheets. We'd love to see anybody else. I know Drew's got like a bajillion spreadsheets and different financial information. I know Zach has a bunch of like stuff like that. Jen probably does too, right? Like I know there's a bunch of data nerds out there. So I would love to see formulas, things that you're looking at, the way that you're analyzing things, share them in the Facebook group. If we get enough of those things, maybe we have a show about different methodologies, right? Like the point is that the more you ask, the more that it challenges us to come up with better and better answers. And we love having crowd generation, community generated topics of what you're trying to learn from. This has been a lot of fun, GC, man. Really good job putting it together. I want to thank the 47 people that are still hanging out with us. It's been an hour and 13 minutes on the middle of a Tuesday. You take this time out of the middle of your workday to hang out with us. That never goes unnoticed. It's really, really an honor to get to do this stuff. If you wanted to learn about owning properties in your portfolio, if you wanted to know about property management, if you wanted to know about markets, you got your share today, right? Like next step, if you want to know more, you want some personalized treatment. If you're a client, talk to your portfolio manager. If not, go to chatwithjwb.com, hop on a call with our experts. It's going to be a good time. And join us on Thursday for the JWB Rental Income Property of the Week. And that's it for me, buddy. Good job by you. I'll give you last words.
Oh, thank you, everybody. I will make sure that we get these charts available. All the slides, we'll put them into the Facebook group. So if you're not a member yet, go to the Facebook group, jwbfacebookgroup.com, jwbfacebookgroup.com. All right, guys, we'll see you on Thursday.
All right. From me, GC, and from Madison today, who you all got to meet. Don't make an average investment. Invest in the best market, Jacksonville. It's been proven.